lines. Here's where a lot of traders get in trouble. The market's behavior at pivot point resistance or pivot point supports can occur differently, different ways the market reacts. Now, some people would look at a pivot point resistance and the market's breaking out of resistance and they'd go long and the market goes right back down against them. Then they'd get up and they go, oh, it's going through resistance again. It's going to go this time. And then it comes back down again. So people get a little bit anxious on what to do at pivot resistance. And that's why I said at the very beginning of the presentation, if you look for sell signals at or near resistance, you will have a better, more fruitful trading plan. Because if you look to buy breakouts of initial resistance, you're going to have probably a very hard time, as you can see in this example, that the market had bounced through the resistance back and forth, and then finally, as the market went from an uptrend, it consolidated, and then the trend went into reversal. And it all happened right here at our pivot point resistance line. Now, we have several different ways that people look at this. Market blasts through resistance, then it comes back, and then they think that resistance is support, and then they start to look to go long. The bottom line is, I always like to look at, in where these areas of resistance, I like to look for sell signals. So if you look for sell signals at resistance, that's why you're using the resistance and support line as a gauge or a tool or a guide to help you. When a market gets too far or advances too much in what we call an unsustainable extreme, we're looking for the market for a quick reaction. I don't care if the British pound goes to 250 to the dollar. I don't care if the euro currency goes to $1.50 to the dollar. I don't care if the Canadian dollar is parity to the US dollar. I'm not an economist. I'm a day trader. I'm trading for a living. I'm looking for shifts in the market, and I'm looking for momentum flows to capture a decent portion of the daily range out of the market that I can profit from, close my trade out, and look for another opportunity the next day. That's the true essence of trading, whether that's your plan for a day, a week, or the month. Whether you're a day trader, a swing trader, or position trader, that's truly what you're looking for as a speculator. So once again, you have to identify who and what you are as a trader. Now, if you are a speculator, that's why it's important to look at these pivot points, because as this example shows, sometimes the market, you look to just sell at resistance, and it's looking at the price behavior. Sometimes the market can go above resistance. Sometimes the market won't quite touch the resistance. And other times, it's just so bizarre and uncanny and amazing that sometimes the market will hit the resistance exactly and then have a market reaction where we see a downside move. Now, there are other times the market gets near this pivot point resistance line and then just takes right off through it and keeps going. So you got to be able to use pivot points as a guide. It's not the holy grail. And that's one of the things that I teach, is to how to use pivot points effectively as a guide rather than relying on them as the holy grail. And I think that's what's going to help you in your trading from here on out. Now, pivot point analysis, unlike Fibonacci studies, relies on specific time frames for its analysis. The calculations that we're going to use will give you the high and the low, or both, for any given trading session. Many times we'll see the high hit, many times we'll see the low hit, but once again, a lot of times we'll see both the high and the low for a given trading session be the exact pivot point, support, and resistance numbers. The same principle goes for the weekly and monthly calculations. A lot of times we're going to see the low or the high hit for the weekly numbers sometime in the middle of the week, and a lot of times the high for the week might be, I don't know if it's going to be Tuesday or Thursday, but we're going to have a range in the week. And some days between Sunday night and Friday's close here in the US, we're going to have a high and a low in the market. A lot of times that high might take only 5 minutes to form. The low might only take 5 minutes to form. So if we have an idea on different time frames, higher degree time frames, such as monthly, weekly, and then daily, we have an idea that if the market gets near a potential resistance of a monthly time frame, gosh, it has to occur sometime, since there are generally 4 weeks to every month. On average, you're going to have one of those weeks make a high and one of those weeks make a low. In fact, in one of those weeks, one of those days will actually represent the high. And in one of those days, think about it. It might occur in an hour, 15 minutes, or break it down in a 5-minute time period. So